Ladies and gentlemen, Asian guy here. Today we are going to dissect a very common belief. COMEX suppresses the price of silver, and an even deeper accusation. China is behind that mechanism. I'm not doing a conspiracy video, I'm doing a case file video. If something has documents, numbers, penalties, and operating rules, we talk about it. If something is only speculation, I will label it as speculation. Here's the starting point. COMEX is not a physical silver vault. COMEX is a futures market, where price is formed mainly through paper trading, and then can sometimes lead to physical delivery. So when you hear the phrase price suppression, you're really talking about price discovery. Contract volume, leverage, and the ability to short into the order book can create short-term downward pressure, even if physical silver out in the real world feels tight. But to accuse organized suppression, you need what markets rarely provide, legal-grade evidence of intentional fraud. And here, history is both yes and no. From 2008 to 2013, the CFTC investigated complaints about silver manipulation on COMEX for years. The official conclusion in 2013, the CFTC closed the investigation and said it did not find a basis to bring an enforcement action under its legal standard. That was a gut punch to the suppression camp. But the story didn't end, because in 2020, another part of the picture was dragged into daylight by penalties. In September 2020, the DOJ, CFTC, and SEC announced that JP Morgan agreed to pay roughly $920 million tied to schemes involving manipulation and spoofing in precious metals and U.S. treasuries. And spoofing is not the simple story of keeping silver cheap for 10 years. It's a technique, placing large orders to create a fake appearance of supply or demand, then quickly canceling them, distorting execution in moments. Regulators explicitly treated it as fraudulent conduct. So does COMEX suppress silver? If you mean, can micromanipulation happen in the order book? The 2020 legal record shows, yes, someone did it and got punished. But if you mean COMEX is designed to suppress silver long term, then you'd have to prove a systemic structural bias, not just a handful of fraud cases. Now we move to structure. On COMEX, silver inventory is typically discussed in two buckets, eligible and registered. Eligible is silver that meets delivery standards but does not have a warrant attached for delivery. Registered is eligible metal that does have a warrant, meaning it's available for delivery. Read that slowly. Eligible does not automatically mean can be pulled and delivered against futures right now. It may simply be someone's metal stored in an approved vault, and the exchange does not directly control whether it gets converted to registered. This is where the optical illusion happens. People look at total inventory and say the vaults are full. But the category that matters most during delivery stress is often registered, which can be much thinner. At times, exchange-reported figures have shown something like registered around 128 million ounces and eligible around 321 million ounces, two completely different layers in terms of deliverability. And when registered is thin, the scary part is not, there's no silver on Earth. The scary part is, if too many participants want delivery at the same time, the system has to reprice the premium, push people toward cash settlement, or trigger a delivery squeeze. Now to the key question. If COMEX can pressure price with paper, what does China have to do with it? There are two layers of answers. A, what IS documented about China, S role in silver supply chains and demand. And B, what is merely a hypothesis about China initiating suppression on COMEX. Layer A, hard facts. Silver is increasingly an industrial metal, not just jewelry or money. Industrial demand has reached record levels, especially from electronics and solar. Reuters has summarized market data along these lines. Industrial demand in 2024 around 689.1 million ounces, solar alone around 243.7 million ounces, and the market recording a large deficit in 2024. The Silver Institute has also put total 2024 demand around 1.16 billion ounces, with industrial drivers staying strong. And the IEA has warned that under certain net zero pathways, silver demand for PV manufacturing by 2030 could rise to a very large share of global silver output compared to today's S share. So where is China in PV? China is the center of the global solar supply chain, mass-scale manufacturing. So a silver shock would hit its costs and schedules early. Does China have an incentive to want cheaper silver? In blunt economics, a country or industry that consumes a lot of silver as an input can benefit from lower input prices. But incentive is not evidence of commanding COMEX. Now layer B, the hypothesis, China initiated suppression through COMEX. I do not see regulators publishing a legal case file that says Beijing coordinated manipulation of silver on COMEX. That has to be stated clearly so this doesn't turn into fiction. However, there is a real-world mechanism that makes people connect China to the price story. China has its own domestic pricing system and benchmarks, and at times, the domestic versus international spread creates a signal that COMEX prices may not reflect physical tightness in Asia. For example, the Shanghai Gold Exchange has published a Shanghai silver benchmark price, an official domestic reference. When the domestic benchmark runs above international pricing, the market talks about premiums and arbitrage. But the existence of a Chinese benchmark does not automatically prove China controls COMEX. It proves there is another pricing center. The better question is, which pricing center forces the other to move? COMEX in London still matter because of derivatives depth and global hedging. The SGE matters because it reflects China's domestic physical conditions. This is where many people misread the picture. They see the US price lower than Shanghai and conclude the US is suppressed. In reality, spreads can come from taxes, import costs, flow restrictions, physical premiums, or differences in contract structure. Back to COMEX. Its power is not that it holds the most silver. Its power is that it has derivatives liquidity. So it creates a reference price for contracts, ETFs, and corporate hedging. And that's why the 2020 spoofing case matters. It shows that in a reference market, micromanipulation can translate into real money, and regulators acted. But who was doing it in that record? The public case record is about JP Morgan and specific traders, not about China. So why do people say China initiated it? Usually 3 folk arguments show up. First, China needs cheap silver to industrialize solar and electronics. Second, China can accumulate physical while price is held down. Third, China is building its own benchmark to escape COMEX. Let's test each by evidence standards. 1. PV demand is absolutely rising. Both the IEA and Reuters frame the pressure, but demand rising is not proof of directing COMEX manipulation. 2. Accumulating physical when prices are low could be true for anyone, funds, corporations, governments, but to claim a state-level operation, you'd need import numbers, strategic stockpile data, or documentary evidence of concentrated buying. I don't have a direct public government document that cleanly proves China did it. 3. Benchmark building is true at the tool level. The Shanghai benchmark exists, but a benchmark can be about domestic market service or pricing autonomy. It still doesn't equal initiating suppression on COMEX. So what is the real center of gravity in the suppression story? It ain't this. Modern silver pricing is a product of 2 parallel flows: derivatives flow, COMEX, and physical flow, spot premiums, industrial demand, logistics. When those 2 flows diverge, you see phenomena like futures price looks sticky, while physical premiums rise, or the Shanghai benchmark prints higher, or the conversation shifts to deliverable silver rather than silver in the ground. To understand suppression, you have to understand leverage. Futures let you control large notional value with a relatively small margin. When liquidity shocks hit, weak hands get forced out. Price can fall, even if the long-term story hasn't changed. That's why many people feel suppressed. They look at physical conditions and industrial demand, but the price is being driven by forced liquidation and derivative structure. From the perspective of a solar manufacturer, the real fear is not silver up 5%. The real fear is delivery failure. Metal arriving late, failing specs, or premiums swinging so hard that the bill of materials plan breaks. This is where politicians enter. Not to say silver, but to say supply chain choke points. In March 2023, Reuters quoted U.S. climate and energy advisor John Podesta saying China has a chokehold over critical minerals, processing, and even solar, and that the U.S. needs to rebuild that capacity. Notice what he did not say. He did not say China manipulates COMEX. He was talking about supply chain power, something that can create geoeconomic leverage without touching the COMEX order book. On China's side, Reuters quoted Premier Li Qiang saying, China opposes cutting off supply chains and wants to strengthen connectivity, an explicit response to de-risking. Those 2 statements frame the China initiated it question in the correct way. If there is strategy, it's more likely to sit in supply, processing, logistics, and licensing mechanisms, not necessarily a hidden hand inside a U.S. futures exchange. So how could China neutralize COMEX? The most plausible path is not price manipulation, but physical conditions that force the reference price to follow. Tightening flows, raising domestic premiums, or absorbing metal into industrial chains. And this is why China AS export controls and other minerals become a precedent. Reuters has reported on China imposing or escalating export restrictions on certain critical minerals in response to trade tensions, sending global prices and supply chains into turbulence. Even if those examples aren't silver, they establish a behavioral template, using control of physical flows as a geopolitical tool. Once markets internalize that template, they start projecting it onto silver. But again, projection is not proof. What we can defend with data is that silver is caught between industrial pull and derivatives market structure. So here's the mechanism map for viewers. Layer 1, COMEX price, deep liquidity, thick derivatives, highly sensitive to positioning and margin. Layer 2, deliverability, depends on registered versus eligible. Eligible being large doesn't mean deliverable supply is large. Layer 3, physical premiums, driven by logistics, taxes, industrial demand, and sometimes import/export rules. Layer 4, structural demand, solar and electronics pulling for years, as emphasized in Reuters and the IEA. Layer 5, supply chain geopolitics. The US talks about chokeholds in minerals and solar. China talks about resisting decoupling. That's the structure. And once you see the structure, the question stops being, is someone pressing a secret button? And becomes, which layer is dominating today and which layer is about to snap? If you ask the COMEX suppresses price question at layer 1, the most reasonable answer is sometimes price can be pressed down in the short run by derivatives structure. And the spoofing record shows real fraudulent conduct has occurred. If you ask the question at layers 2 to 3, you'll see that physical tightness can coexist with futures not exploding, because delivery flow and physical premiums are different from screen price. If you ask China initiated it, you're jumping straight to layer 5. And at layer 5, the most accurate framing is China has supply chain leverage across many materials. So markets tend to map that story onto silver. But there's no public case file proving China coordinated manipulation of COMEX. Now a concrete example so viewers can feel the difference between manipulation and structure. The 2013 said there wasn't T enough basis to bring a silver manipulation case from the 2008-2013 investigation. But in 2020, regulators punished spoofing or manipulation conduct in precious metals. Those two facts dawn a T conflict. One is an allegation of large-scale, long-horizon price suppression. The other is micro-level fraud with evidence. What makes the silver community furious is they look at 2020 and say, then 2013 was wrong. The colder reality is, standards of proof, the record, and the scope of alleged conduct can differ. A market can fail to meet the bar for